Well, this week we're not necessarily looking at a fund. We're focusing on Target Volatility Controlled Indices, and these are whether these are the best options for managing risk associated with emerging market equities, where money can flow quickly into the market and just as quickly move out of the market. Kobe, set the scene for us. Tell us what these TVCIs, as they are known, are.
Okay, well, listen, I'm going to do this with the help of Lawrence, okay, because I think this is actually a product that Lawrence is actually responsible for inside Barclays Capital. But let me try and explain to you what and how TVCI in essence works. We have a table that we'd like to show you that'll kind of explain it to you. In essence, if you are exposed to a market, you buy the complete market and you're exposed to the total movement in that market. If you want to lose less money than what the market, if the market drops, you need to ensure that there's some money in cash. And in essence, what a TVCI index does is it does so automatically for you without you having to do so as an investor on your own. And the way in which it works, in essence, is by you setting a specific volatility level. And there you can see, you set the volatility level at 15%, and if the actual volatility of the index is at 15%, you will have 100% exposure to the actual market, which means 100% exposure to the actual share market. If the volatility goes up, and let's assume it goes up to 30%, you see what happens to your participation rate now. It goes down to 15%. And you do so by actually dividing the 15 by the 30%, which is that initial target volatility that you set beforehand. The other side of the equation, though, and Lawrence, maybe you need to help me here, is with the volatility, the actual volatility drops, it actually allows for a leveraged exposure. Is that true, Lawrence? Does it allow you for leveraged exposure?
It does indeed. And you know, why does it do this? If you think about a stock, when a stock goes up, it generally goes up with low volatility. So if, for example, you were to take a graph of Apple over the last couple of years, Apple has generally tended to drift up at a very slow pace with very low volatility, but it's been going up. So when there is low volatility in the market, you really want to capture that. So thus, we allow a bit of leverage. And essentially, if an investor was to invest 100, we, on behalf of the investor, would borrow 50 if we wanted to invest 150 and charge a small interest rate on that. So the investor would get 150%.
Let's take a step back. These TVCIs are actually based on proper indices, based on underlying indices or futures, options products. So tell us about that.
Sure. Well, you know, actually to take one further step back, you know, talking about the basic principle of these indices. And they're actually built on a concept that we all understand from the recent financial crisis. And it's simply this. When volatility has gone up, stock prices have tended to fall. And that's the simple principle that we use here. We monitor volatility, and if volatility rises, we invest less into the index and more into cash, as Kirby explained. And then, when volatility subsides, we invest more into the underlying index. You know, so thus we can provide stabilized returns, and that is key for the investor.
Yeah.
It's two reasons.
And it's automated. It's a rules-based kind of strategy.
Absolutely, Roland. Everything is 100% rules-based and it's non-discretionary. And you know, the benefits are stabilized returns and reduced drawdowns.
So do you monitor this on a daily basis? So the one day we see the market up by, 2% or whatever it may be, the next day the market's in the red. Are you adjusting this on a daily basis, or how often do you adjust exposure to equities?
Absolutely. You know, we have algorithmic tools that monitor this on a daily basis, and we'll change the exposure based on the underlying volatility. So we do this on a daily basis.
Do you use a rolling window or some kind of realized volatility date range that you roll forward?
Yes, indeed we do. We actually look at the maximum of the 20 and the 40 days. So thus those two windows allow us to be quite reactive to the market and pick up when volatility is rising.
Yeah, and I think the important thing here is to take into consideration, and Lawrence, please correct me if I'm wrong, and that is that if you're a day trader, this is not going to help you. Because if it's intraday volatility, it's not necessarily going to protect you from intraday volatility. What it is going to protect you from is kind of for a long-term investor, ensuring that you kind of get the right kind of spread between equities and cash over time. We have a graph that will actually show you how this actually works in principle. This is a Bloomberg screenshot. And what you're looking at is you're looking at a white line running through the screen. That is the S&P brick TVCI, or the BRIC 40 TVCI index, or the risk controlled index. And the starting point here actually is in March 2009. And you can see how the index kind of rises in value, and then it falls far less in value than its counterpart, which is just the naked or the normal S&P BRIC 40 total return index. And hence there you can kind of see it, kind of in action. If we go to the next graph, you can see kind of the volatility levels, and this goes back to 2005. You can see the volatility that you are exposed to in the risk control index is far less than what you are in just the naked or the normal index.
And that average is what you set the volatility to be. So if I think that graph was 20% volatility, it will deviate from that, but it will give you that average through the cycle over time.
Absolutely correct. It's around, if it's around 20, the realized volatility is around 20. But in moving back to one of Kirby's key points is, if you look at that graph, you'll see that the naked index went down almost 55% in 2008, whereas the risk control index went down about 25%. So that's a significant savings, and avoiding drawdowns is a key financial principle that can help investors.
The question I have is, how do you decide the level of volatility that you want to adopt? What are the key considerations? Because you have various products with various volatility levels. What type of questions should an institutional investor, an asset manager ask when deciding which product to choose?
Yeah, that's a great question. Actually, when we're designing these indices, we normally actually roll out a couple target volatility controlled indices with different volatility levels. So, for example, with an emerging market one, we may choose a volatility level of 15, 18, and 20. So we try and match the volatility levels to the appropriate underlying. So, for an example, if underlying emerging market index is pretty volatile, we don't want to have the level too low. So at 5%, that wouldn't allow the investor a good exposure and a good participation. So we always, with emerging market indices, try and have the target volatility levels a little bit higher.
Okay, so what are your thoughts on this product as a way to manage volatility from the outside perspective?
I guess we all have two choices when we're investing. We can chase returns. We can hire a manager to try and outperform an index. If you do that, you tend to incentivize them to take risk, because the only way you can outperform is if you take risk. Now, that is obviously one way of doing it, but you will have the full exposure to the underlying index or market that you are trying to outperform. With this kind of concept, you are not trying to outperform. You are trying to avoid the periods where you lose a lot of money, which traditional active management has not been very successful at. So I certainly see a role as a complement to your existing portfolio to directly and explicitly manage risk, whereas what we're doing at the moment is we're indirectly managing risk through an active management process. This is saying our main target is avoiding loss, not outperforming an index.
So how applicable is this to asset managers in terms of building a balanced portfolio?
If I look at it from a global perspective, and I look at it from a Western world perspective, and I want to invest into BRIC, immediately the risk becomes a major issue. And the question is, how do you control for that? And I think from their perspective, it makes a huge difference. I think the other thing to consider is,
but from our perspective, say you're sitting as an asset manager here in South Africa, same role that it would play in your portfolio?
Well, it's a good question to ask, because we have a table that I'd like to show you at the moment. Because one thing that we might say in South Africa is that, why worry with BRIC? Because we are in the S of BRICS in any case, so why bother being in BRIC? And I want to show you the excess return that you could actually, or the annual excess return you could be making out of the BRIC index, and this is over the last 8 years, relative to the JSE index. And as a matter of fact, if you then create an index which is 70% JSE and 30% BRIC or S&P BRIC, you could potentially start, hiking the returns that you could potentially get. But obviously, the volatility obviously increases relative to what it is in the JSE index. And just to show you what a graph looks like as far as that's concerned, there you can see it. There's a portfolio relative to just the JSE. So again, having BRIC exposure from a South African perspective still makes sense. The question is, how do you control for the volatility? Because you're not necessarily on home turf, and you certainly want to be doing something like that. I mean, is that true, Lawrence?
Yeah, absolutely. I mean, I've been involved in designing these indices for the last couple of years. And what I've seen is that a target risk control index always has better, sharper returns. So if you look at the Sharpe ratio, significantly higher than the underlying base index.
Is this really based on a market right now, though, that is so volatile and is so uncertain? Have you seen a huge spike in demand for this, I suppose, post the 2008-2009 crisis?
Absolutely. I mean, that's, for example, with the target risk control indexes, S&P who created this brick index. They've sold more than $10 billion of this index. And here at Barclays, we've seen a tremendous demand. In the last quarter, we've sold over $1 billion of product, and a lot of it has been linked to volatility and volatility controlled indices. So it's a huge trend that we're seeing in the market.
It's not just retail, it's institutional pension fund kind of investors as well.
Yeah, it's across the whole spectrum. It's retail and institutional. Everyone's been buying it.
Okay, so obviously S&P has it, and that's what you're in association with, but MSCI also have their own TVCI. Is there any difference between the ones you have and they have?
You know what, that's an interesting point, because what we're seeing is a bit of a convergence around the methodology. There's a number of ways you can use to control these indices, but generally the market is tending towards one standard methodology. And actually at Barclays we create our own indices, and we actually also have adopted a standard methodology. It makes it easier to explain to investors. They want to understand one concept, don't have to explain too much, and people are comfortable with it, and then they think about buying the product.
I mean, Lawrence, just quickly give us an indication. How does African and South African investors get exposure to something like this?
ABSA is actually offering a product linked to this index. It's denominated in South African Rand, 100% capital participation, and this is available through ABSA Financial Advisors.
Okay, so that's one way to manage risk and manage volatility, rather. Roland, your thoughts on the type of other options that someone who's looking at the risk that we have in the markets right now, whether it be in developed world markets or emerging markets, what are the other ways that one could look at managing this?
I guess the most common way to explicitly manage risk is to buy a derivative. So you can buy options, put options, you can buy a call option. These things tend to manage your downside risk very explicitly. They can be very costly, but they certainly do have a role to play. One of the issues with those is they're only valid over a fixed term. So it's 6 months, a year, and then you have to roll it and you have to get a new contract that will protect you for the next 6 months or the next year. Whereas this is a dynamic kind of index that sort of keeps doing this rules-based strategy over time, and therefore you don't have to worry about the problem of
the time horizon that you've chosen.
Yes.
You could miss it by a day.
Exactly.
So just add to that in terms of this versus the derivative products.
Yeah, absolutely. Well, I think if you think about buying a put option, you have a number of issues. One is you have time decay or theta of your put option, and certainly you have cost of management. You have to think about, when do I buy the next one? How many do I have to buy? If you buy it at a certain point, the market may move away. The
volatility changes, and the price
you may not get
of
reactivity. So actually, this is using a target volatility controlled index. It's a lot more effective because it's a simpler, clearer methodology. You don't have to worry about the time decay of purchasing an option, and you get a dynamic exposure where you can get this leverage to increase your exposure when markets are stable.
Look, you certainly can get a loss in these indices, right? They do go down, but you are targeting the volatility to stay within a tight band, and that is desirable. If you can tolerate a specific level of volatility, then buy something that gives you that volatility, whereas you don't get that necessarily from a naked position in the market.
And you're obviously buying it, of course, with the actual underlying indices that you're targeting,
That's correct. I mean, the Target Volatility Controlled Index will invest in the underlying index and cash. And the amount it invests is just determined on the underlying level of volatility.
I mean, I think the big thing to consider here is, for an active asset manager to make use of a product like this, you're going to have to go and calculate the match or the mismatch between the active holdings that you have and potentially the index. And this is a way, for instance, if markets become quite expensive and you're not quite sure of the direction of the market, you might start taking money off the table as far as your active positions are concerned and start putting it into something like this. Because you're going to get leveraged exposure when markets will go up, but you're definitely going to get the protection on the downside, and you don't have to worry about rolling over, as Roland said just now, your put options and trying to reset and marking to market on a daily basis. You don't have to worry about any of that stuff.
Okay, downside risks. Are there any risks that, apart from that, as you say, we have put them on the table, but just something that you would have to highlight to someone who's potentially a client of these products?
There's one potential shortfall, and that is when you have an extreme one-day event. So say, for example, if you have a natural disaster, the volatility controlled indices, they need to pick up a rise in volatility, whereas if you have a natural one-day event where the markets suddenly crash, the index will not be able to pick that up. But generally, they do pick up market events that occur over time, but a natural disaster over one day may struggle at that point.
Overall, does this sound like a product that you'd be wanting to use?
If you are wanting to sleep more easily and have exposure to markets that is dynamic rather than either 100% or nothing in the market, then something like this can certainly play a role there.
Okay, well, you do work for Absa Capital, so we know there's a product there that they have, but we'll just put that on the table. But of course, I'm sure you're not biased in this one.
You should have asked me that question.
I should have asked you that question, maybe. Anyway,
I think it's a good product. I
Yeah.
I certainly think it's got huge amounts of merit.